Let's try to understand part 4, that is differences between venture capital, venture debt and private equity. So I have taken basis, the differential basis of these following topics, that is. So the first one is objective. Let's discuss about the objective differences between VC, VD and PE, that is venture capital, venture debt and private equity. The objective in venture capital, it's to get maximum returns. If it is a venture debt, they'll be satisfied with interest on the loan they get. Whereas in private equity, the objective would be to take over the firm or have maximum control. And then the second basis of difference is, let's consider period. Venture capital usually venture capital investment usually lies between 2 to 5 years, and this is say 6 months to 3 years. That is, venture debt is usually for a shorter term, that's half year to 3 years, and private equity is usually for long or permanent period. And then we'll move on to the next basis, that is instruments. Equity shares are given when it is venture capital investment. In case of venture debt investments, warrants or debentures are given, and if it is in the case of private equity, equity shares again, which is similar to venture capital. And moving on to the basis of collateral. The collateral in this case is very rare, and in case of VD, it's still no, is absolutely no, and in case of private equity, it's still very rare. Ownership, yes, the venture capital firms, they have minor stake because they get equity shares. Here, there's no ownership. That's the whole purpose of whole characteristic of venture debt. And private equity, it's complete or major ownership. Next, control. So they have minority shares. They have venture capital, they have minority shares, and venture debt, they have agreements or covenants. So that's how they have the control, they can be executed. And here they have the control by way of course, shares, and they have their nominee as a board member. And if a company undergoes loss, then it will definitely hit these companies. In the case of a venture capital company, the loss could go from anything between 30% to 50%. In case of venture debt, because it is only interest based, so the loss sometimes it can still go from 2 to 4%. In case of private equity, it's not applicable because it is their personal interest to have control in the company, and of course it is them who are managing the company. So whether profit or loss, it shouldn't matter. And exit strategies. Venture capital, they go for IPOs, okay, or they'll be open for mergers and acquisitions. There's a principle or method called cash cow, that is, if the company is doing well, they'll let it go. This is called milking it, and of course, complete sale. Whereas the exit strategy is getting the loan repaid. Okay, the exit strategy in private equity is, I've literally mentioned it as not applicable. However, IPOs are seen here, but the reason I've mentioned not applicable here is because it is completely their call, because they have ownership already. So it could be IPOs or selling stake to the promoters, okay, or any decision they take it because they are owners. So that's about the basic differences between venture capital, venture debt and private equity. I hope this presentation was useful and resourceful. Thank you.